A country's deficit is often spoken about as if it were a moral failing. Headlines frame it as excess, irresponsibility, or indulgence, governments spending beyond their means, living on borrowed time. But in economic reality, a deficit is not a single thing. It is a signal, a tool, a symptom, and sometimes a deliberate choice. To understand how deficits have shaped nations across history and how they will shape the future, we first need to slow down and understand what a deficit actually represents. At its simplest, a government deficit occurs when public spending exceeds public revenue in a given period, usually a fiscal year. Revenue comes primarily from taxation, fees, and state-owned enterprises. Spending includes everything from healthcare, pensions, infrastructure, and education to military budgets, interest payments, and emergency interventions. The difference between the two is financed by borrowing, issuing government bonds, bills, or notes that are purchased by domestic investors, foreign governments, financial institutions, or central banks. But this mechanical definition hides something essential. A deficit is not inherently good or bad. Its meaning depends entirely on context, economic conditions, institutional strength, currency regime, demographics, and global financial positioning. The same numerical deficit can stabilize one economy while destabilizing another. Historically, deficits emerged as modern states expanded beyond minimal governance. Early governments relied heavily on tariffs, land rents, or episodic taxation, often running balanced budgets by necessity rather than design. Persistent deficits became common only when states gained reliable access to credit markets and developed bureaucratic capacity to tax future income. In that sense, deficits are inseparable from the rise of the modern nation-state. From an economic perspective, a deficit is best understood as intertemporal choice, a decision to shift resources across time. Governments borrow today with the expectation that future economic output will be larger, making repayment manageable. When deficits fund productive investments, transport networks, education systems, public health, technological development, they can raise long-term growth and actually reduce future fiscal strain. When they fund consumption without future payoff, they can quietly compound risk. Crucially, deficits must be distinguished from debt. A deficit is a flow, debt is a stock. A country can run small deficits for decades and accumulate substantial debt, or it can run large deficits briefly during crises without long-term damage. What matters is not the existence of debt itself, but whether the economy grows faster than the debt burden. When growth outpaces interest costs, debt becomes easier to carry, even if nominal levels rise. This is where intuition often fails. Households cannot print money, control interest rates, or tax future income. Governments can. That difference makes public finance fundamentally unlike personal finance, despite how often the two are compared. A government that issues debt in its own currency and maintains monetary credibility operates under a radically different constraint set than a household or firm. Deficits also serve a stabilizing function. During recessions, tax revenues fall automatically while social spending rises, unemployment benefits, income support, emergency programs. These automatic stabilizers widen deficits without new legislation, cushioning economic downturns. Attempts to eliminate deficits during recessions often worsen economic contractions, reducing revenue further and paradoxically increasing debt burdens. This insight, learned painfully during past economic crises, reshaped macroeconomic thinking in the 20th century. Deficits came to be seen not merely as accounting outcomes, but as instruments of economic management. Fiscal policy, deliberate changes in spending and taxation, became a way to smooth business cycles, support employment, and prevent systemic collapse. Yet deficits also introduce trade-offs that never disappear. Borrowing ties the present to the future. Interest payments divert future revenue away from public services. Heavy reliance on external creditors can introduce vulnerability to capital flight, exchange rate pressure, or political leverage. Persistent deficits can crowd out private investment if they push interest rates higher, or fuel inflation if they exceed an economy's productive capacity. Importantly, not all deficits are chosen. Wars, pandemics, financial crises, demographic shifts, and climate shocks impose fiscal demands regardless of ideology. History shows that nearly every major expansion of public debt followed an emergency rather than a policy preference. The question is rarely whether deficits will occur, but how countries absorb them, manage them, and emerge afterward. As we move forward in this series, we will see how different nations, under vastly different conditions, have used deficits to industrialize, to stabilize, to rebuild, and sometimes to unravel. We will see why some countries sustain high debt levels with little stress, while others face crisis at far lower thresholds. And we will examine how today's global environment, aging populations, slowing growth, climate transition, geopolitical fragmentation, changes the meaning of deficits yet again. This first step is essential to strip deficits of moral framing and understand them as economic instruments embedded in time, structure, and power. Only then can we begin to ask the harder questions: when they help, when they harm, and what the future is likely to demand. Long before deficits became tools of economic management, they emerged out of necessity, specifically the necessity of war. The earliest sustained government deficits were not the result of social programs or economic stimulus, but of armies, fleets, and empires that outgrew the immediate revenues of the states that built them. In pre-modern economies, most governments tried, often unsuccessfully, to balance their budgets year to year. Tax systems were inefficient, records were incomplete, and political resistance to permanent taxation was strong. When extraordinary expenses arose, especially military ones, rulers faced a simple problem. Wars demanded resources immediately, while taxation collected slowly. Borrowing filled that gap. This was the origin of sovereign debt markets. States that could convince creditors they would survive long enough to repay them gained access to capital on unprecedented scale. Over time, those states learned something subtle but powerful. Credit itself could become a strategic asset. One of the earliest and most influential examples was Netherlands in the 17th century. As a small trading republic locked in costly conflicts, it developed sophisticated public finance institutions, regular bond issuance, credible taxation, and legal protections for lenders. Dutch deficits were not temporary accidents. They were embedded in a system that assumed long-term borrowing as normal. Because creditors trusted the state, interest rates stayed low, allowing deficits to persist without immediate crisis. This model was refined and expanded by United Kingdom. Britain's rise as a global power was inseparable from its ability to finance war through debt. The creation of permanent institutions, most famously the Bank of England, allowed the government to issue long-dated bonds backed by predictable tax revenues. Britain ran enormous deficits during wars with France, especially in the 18th and early 19th centuries, yet avoided collapse because its economy expanded and its institutions remained credible. The result was a paradox that would echo through history. The most indebted states were often the most powerful, not the weakest. Deficits funded fleets, infrastructure, and colonial administration, which in turn expanded trade and tax bases. Debt did not constrain empire, it enabled it. Contrast this with states that borrowed without institutional support. In early modern Spain, massive inflows of silver financed imperial ambition but undermined fiscal discipline. Weak tax systems, reliance on short-term borrowing, and repeated defaults eroded creditor trust. Spain's deficits were large but unstable. Rather than smoothing shocks, borrowing amplified them, leading to repeated fiscal crises despite vast resource inflows. The key difference was not the size of deficits, but the credibility of the state behind them. Where governments could tax effectively, honor contracts, and maintain political continuity, deficits became sustainable. Where they could not, deficits became precursors to default, inflation, or collapse. By the 19th century, Deficits had become routine during emergencies and recessions, but still politically sensitive. Many governments viewed peacetime deficits as dangerous or illegitimate, associating them with moral decay or fiscal weakness. Balanced budgets were often treated as symbols of virtue rather than economic outcomes. This mindset shaped responses to early industrialization. Governments hesitated to borrow for infrastructure or social investment, fearing debt accumulation. Yet those that did, railways, ports, canals, education systems, often reaped long-term gains that dwarfed their initial deficits. Fiscal conservatism protected stability, but sometimes at the cost of growth. Importantly, deficits during this era were not designed to manage economic cycles. That idea had not yet emerged. Governments reacted to crises after they happened rather than attempting to prevent them. Recessions, financial panics, and unemployment were treated as unavoidable features of economic life, not problems fiscal policy could solve. What this period reveals is a recurring pattern that still defines deficit politics today. Deficits are most politically acceptable during emergencies. Institutional strength determines whether deficits stabilize or destabilize. Debt sustainability depends more on credibility and growth than on absolute size. Moral framing often lags economic reality. By the end of the 19th century, governments had mastered the mechanics of borrowing, but not yet its macroeconomic implications. That transformation would come in the 20th century, when deficits stopped being episodic responses to war and became deliberate tools of economic stabilization. In Segment 3, we'll move into that turning point, the Great Depression, the collapse of balanced budget orthodoxy, and the moment deficits became central to modern economic policy rather than reluctant last resorts. The modern understanding of government deficits did not emerge gradually. It arrived abruptly under pressure during one of the most severe economic collapses in recorded history. The Great Depression forced governments to confront a reality they had long resisted. Balanced budgets could deepen crises, and deficits, once feared, might be necessary for survival. When global economies began to contract after 1929, most governments responded according to the fiscal logic of the time. Revenues collapsed as incomes fell and trade slowed. In response, many states cut spending, raised taxes, and attempted to defend balanced budgets. The logic was straightforward: restore confidence, protect currency stability, and avoid accumulating debt. The outcome was catastrophic. As governments withdrew spending, private demand collapsed further. Unemployment surged, businesses failed, and tax bases shrank even more. Efforts to reduce deficits often increased them instead, as shrinking economies generated even less revenue. Fiscal restraint, intended to restore stability, amplified economic freefall. This experience shattered the assumption that government budgets should behave like household budgets during downturns. It also exposed a deeper insight. When the private sector cannot or will not spend, the government becomes the spender of last resort. This shift in thinking was crystallized by the work of John Maynard Keynes. Keynes argued that during periods of insufficient demand, government deficits were not signs of irresponsibility, but necessary counterweights. By borrowing and spending when households and firms pulled back, governments could stabilize output, preserve employment, and prevent long-term economic damage. Deficits, in this view, were not failures to be avoided at all costs. They were tools to be used deliberately and withdrawn when recovery took hold. The most prominent real-world test of this approach occurred in the United States during the 1930s. Programs under the New Deal expanded public spending dramatically. Infrastructure projects, employment programs, and social safety nets widened deficits, but they also injected demand into an economy trapped in deflationary collapse. Importantly, these deficits did not end the Depression on their own. Full recovery came only with the massive fiscal expansion of World War II. But the lesson was unmistakable. Large deficits did not automatically produce financial collapse, and under the right conditions, they could coexist with falling debt burdens relative to economic output. World War II marked a second, even more dramatic shift. Governments across Europe and North America ran deficits of unprecedented scale. Debt levels exploded, often exceeding the size of annual national output. Yet instead of triggering post-war crisis, many countries entered decades of growth, declining debt ratios, and rising living standards. This outcome rewired fiscal thinking. High debt accumulated during existential crises could be managed if post-crisis growth was strong and interest rates remained low. What mattered was not the debt itself, but the economic environment that followed. The post-war period also institutionalized deficit management. Automatic stabilizers expanded, welfare states grew, and central banks increasingly coordinated with fiscal authorities. Governments accepted that deficits would widen during downturns and shrink during expansions, a pattern known as countercyclical fiscal policy. However, this new consensus contained tension. While deficits were now accepted during recessions, many policymakers still feared them during periods of growth. Political incentives often favored continued spending without equivalent revenue increases, leading to structural deficits that persisted even in good times. This distinction between cyclical deficits driven by economic conditions and structural deficits embedded in policy choices became central to fiscal analysis. Cyclical deficits were stabilizing. Structural deficits were ambiguous, depending on how they were financed and what they funded. By mid-century, deficits had been reframed from moral failures into macroeconomic instruments. But that reframing was incomplete. The success of post-war growth masked underlying vulnerabilities, ones that would surface later when growth slowed, inflation rose, and the assumptions supporting deficit tolerance began to fracture. In Segment 4, we'll examine that fracture, the inflationary crises of the 1970s, the backlash against deficits, and the return of fiscal restraint as governments grappled with the limits of deficit-driven stability. By the late 1960s and early 1970s, the post-war fiscal consensus began to crack. For decades, governments had grown accustomed to running deficits during downturns and tolerating moderate debt levels during expansions. Growth was strong, unemployment was low, and inflation, while present, seemed manageable. The assumption was that governments had learned how to smooth the business cycle. Then the world changed. A series of shocks, oil price spikes slowing productivity growth, demographic shifts, and geopolitical instability, produced a phenomenon few economists had seriously anticipated: stagflation, the simultaneous presence of high inflation and weak economic growth. This combination undermined the intellectual foundation of deficit tolerance built during the post-war era. Under earlier models, inflation and unemployment were expected to move in opposite directions. Governments believed they could trade a bit more inflation for lower unemployment through deficit spending. But during the 1970s, inflation rose even as growth stalled and joblessness increased. Deficits no longer appeared stabilizing. They seemed destabilizing. In countries like the United States and United Kingdom, government budgets deteriorated while inflation surged. Deficits were no longer funding clear productivity-enhancing investments. They were increasingly absorbed by entitlement growth, military spending, and interest costs. As prices rose, creditors demanded higher interest rates, raising the cost of borrowing and feeding a vicious cycle. This era exposed a critical constraint on deficits. They are sustainable only when an economy has unused capacity. When factories are idle and workers are unemployed, government spending can expand output without triggering inflation. But when supply is constrained by energy shortages, demographic limits, or productivity stagnation, deficits push demand into bottlenecks, raising prices rather than output. The policy response was dramatic. Central banks asserted independence and raised interest rates aggressively to break inflation. Fiscal policy shifted toward restraint. Deficits, once framed as stabilizing tools, were recast as sources of inflationary risk and long-term decline. The intellectual movement behind this shift emphasized credibility, expectations, and market discipline. Governments, it was argued, could not permanently spend their way to prosperity. Persistent deficits would eventually undermine confidence, raise inflation expectations, and erode currency value. Fiscal discipline became synonymous with economic seriousness. This shift reshaped global policy. In Germany, historical memory of hyperinflation reinforced aversion to deficits. Balanced budgets and low inflation became institutional priorities. In the European Union, deficit limits were later embedded into fiscal rules designed to constrain member states regardless of economic conditions. Meanwhile, many developing countries faced a harsher version of the same reckoning. Throughout Latin America and parts of Africa, deficits financed through foreign borrowing collided with rising global interest rates. Debt burdens exploded, currencies collapsed, and inflation surged. For these countries, deficits were not abstract policy debates, they became pathways to crisis. The lesson of the 1970s was not that deficits were always dangerous, but that context mattered more than theory. Deficits, without productive capacity expansion, could ignite inflation. Borrowing in foreign currencies magnified vulnerability. Weak institutions turned fiscal stress into systemic failure. By the early 1980s, deficit skepticism dominated economic policy. Governments cut spending, privatized assets, deregulated markets, and emphasized monetary restraint. Inflation was brought under control, but often at the cost of higher unemployment and slower wage growth. This era left a lasting imprint. Even as later decades would reintroduce deficit tolerance under new conditions, the memory of stagflation remained a warning signal, a reminder that deficits are not neutral tools and that their risks emerge when economic limits are ignored. In Segment 5, we'll examine how deficits evolved in the late 20th and early 21st centuries, how globalization, financial markets, and demographic change altered both their scale and their consequences. By the late 1980s and into the 1990s, government deficits entered a new phase, not because they disappeared, but because the world around them fundamentally changed. Inflation had been subdued, capital markets had expanded globally, and financial systems became deeper, faster, and more interconnected than ever before. Under these conditions, deficits stopped looking like emergencies and started looking normal. One of the most important shifts was global capital mobility. Governments were no longer borrowing primarily from domestic savers. They were borrowing from pension funds in other countries, foreign central banks, global investment firms, and international institutions. This dramatically expanded the pool of available credit and lowered borrowing costs for many advanced economies. In countries such as the United States, persistent deficits became structurally embedded without triggering immediate stress. Treasury bonds were treated as global safe assets. As long as the U.S. economy remained large, innovative, and politically stable, global demand for its debt remained strong, even as absolute debt levels climbed. This period revealed a critical asymmetry in the global system. Not all countries faced the same deficit constraints. Nations that issue debt in their own currency, maintain deep financial markets, and enjoy geopolitical influence can sustain deficits that would destabilize others. For them, deficits became less about solvency and more about inflation, growth, and political choice. At the same time, globalization exerted downward pressure on inflation. Manufacturing shifted to lower-cost regions. Labor bargaining power weakened in advanced economies. Cheap imports and global supply chains kept consumer prices relatively stable. This allowed governments to run deficits without triggering the inflationary backlash seen in the 1970s. Financialization amplified this effect. Expanding credit markets, derivatives, and asset-backed securities absorbed government debt easily. Interest rates trended downward for decades. Servicing debt became cheaper even as debt volumes grew. In this environment, deficits appeared manageable, almost invisible. But the calm was unevenly distributed. In Japan, deficits exploded after the collapse of its asset bubble in the early 1990s. Growth stagnated, tax revenues fell, and repeated fiscal stimulus programs expanded public debt to levels unseen in peacetime. Yet Japan avoided inflation and default. Why? Because its debt was domestically held, its currency sovereign, and its population inclined towards saving rather than capital flight. Japan became a living counterexample to deficit panic: extremely high debt, extremely low interest rates, persistent deficits, and no immediate fiscal crisis. This forced economists to rethink rigid debt thresholds and focus instead on structure, demographics, and monetary conditions. By contrast, countries without monetary sovereignty faced harsher limits. In parts of Latin America, Eastern Europe, and Southeast Asia, deficits financed through foreign borrowing remained dangerous. Currency mismatches, borrowing in dollars while earning revenue in local currencies, turned fiscal stress into balance of payments crises when capital flows reversed. The Asian financial crisis of the late 1990s demonstrated this clearly. Countries with modest public deficits still collapsed because private sector borrowing and external imbalances overwhelmed national balance sheets. This blurred the line between public and private debt, revealing that deficits alone do not define fiscal vulnerability. Total system leverage does. Another major shift occurred in Europe. The creation of a shared currency under the European Union removed monetary flexibility while preserving national fiscal authority. Member states could run deficits, but they no longer controlled currency issuance. This arrangement worked smoothly during periods of growth and low interest rates, but it quietly transformed deficits into potential fault lines. During this era, fiscal debates increasingly centered on rules rather than outcomes. Deficit ceilings, debt-to-GDP targets, and balanced budget amendments were introduced to impose discipline. These rules were designed to prevent political short-termism, but they often ignored economic context, forcing austerity during downturns and limiting public investment even when borrowing costs were historically low. By the early 2000s, a paradox had emerged. Deficits were larger and more persistent than ever. Debt servicing costs were lower than ever. Growth was slowing, not accelerating. Inequality was rising despite fiscal expansion. Deficits were no longer primarily funding transformative infrastructure or broad-based growth. Increasingly, they stabilized financial systems, supported asset prices, and backstopped aging social programs. The economic returns on borrowing were becoming less visible, even as reliance on deficits deepened. This era normalized deficits without resolving their long-term implications. Governments learned how to live with them, but not necessarily how to use them productively. Stability was maintained, but fragility accumulated beneath the surface. In Segment 6, we'll examine the moment when that fragility was exposed: the global financial crisis of 2008, the sudden explosion of deficits worldwide, and how emergency borrowing reshaped the relationship between governments, central banks, and markets. The global financial crisis of 2008 did not begin as a government deficit problem. It began as a private sector collapse, over-leveraged banks, opaque financial instruments, and asset bubbles built on cheap credit. But when the system began to fail, governments became the final backstop. Almost overnight, deficits exploded across the world, not as policy experiments, but as acts of containment. As financial institutions faltered, credit froze. Businesses could not roll over loans, households cut spending, and global trade contracted sharply. Tax revenues collapsed just as public spending needs surged. Governments stepped in to stabilize banks, guarantee deposits, and fund emergency stimulus programs. The result was a synchronized global expansion of deficits unprecedented outside wartime. In the United States, deficits ballooned as financial rescues, fiscal stimulus, and automatic stabilizers combined. Similar patterns emerged across Europe and parts of Asia. What mattered was not ideological preference, but systemic risk. Without government intervention, core financial infrastructure would have failed. The crisis fundamentally altered the relationship between fiscal and monetary policy. Central banks cut interest rates to near zero, and when that proved insufficient, began purchasing government bonds and other assets on a massive scale. This process, quantitative easing, effectively absorbed a large share of newly issued public debt. For the first time in modern history, governments could run enormous deficits while borrowing costs continued to fall. Markets did not punish this behavior, they demanded it. Government bonds became safe havens, and yields declined even as debt levels soared. This shattered one of the central fears surrounding deficits, that markets would automatically rebel against large-scale borrowing. Instead, markets rewarded countries with credible institutions, independent central banks, and deep financial systems. The constraint was no longer access to capital, it was political consensus. However, this new environment exposed sharp divergences between countries. Within the European Union, the crisis revealed structural vulnerabilities. Member states that did not control their own currency faced rising borrowing costs despite running smaller deficits than some peers. Countries like Greece and others experienced debt crises not because their deficits were uniquely large, but because they lacked monetary backstops. Austerity followed, deepening recessions and delaying recovery. Elsewhere, countries with currency sovereignty absorbed deficits more easily. In Japan, already high debt rose further, yet interest rates remained near zero. The difference lay not in fiscal virtue, but in institutional architecture. The crisis also transformed the purpose of deficits. Rather than funding new growth engines, much of the borrowing went toward stabilizing existing systems, banks, pensions, housing markets. Deficits became defensive rather than developmental. They prevented collapse, but did not necessarily create future capacity. This shift had long-term consequences. As central banks held large quantities of government debt, fiscal policy became indirectly constrained by monetary considerations. Governments grew accustomed to low borrowing costs, while central banks assumed expanded roles as market stabilizers. The boundary between fiscal and monetary policy blurred. Public attitudes toward deficits also changed. Emergency borrowing became normalized. What once would have triggered political panic became routine budgetary expansion. Yet resentment simmered beneath the surface. Bailouts were seen as favoring financial elites, while wage growth stagnated and inequality widened. The post-crisis decade was marked by an uneasy equilibrium, large deficits, ultra-low interest rates, subdued inflation, and slow growth. The system appeared stable, but heavily reliant on continuous intervention. The question was no longer whether deficits were dangerous, but whether economies had become dependent on them. In Segment 7, we'll move into the most recent turning point, the pandemic-era deficit explosion, the return of inflation, and the renewed debate over how far deficit tolerance can stretch in a world facing structural constraints. The global pandemic marked the most abrupt and expansive fiscal intervention in modern economic history. Unlike the financial crisis, which unfolded through markets and institutions, this shock froze the real economy almost overnight. Entire sectors were shut down by policy choice. In response, governments did something previously unthinkable. They replaced large portions of private income directly with public spending. Deficits surged everywhere, regardless of ideology or prior fiscal stance. Emergency income supports, wage subsidies, business loans, healthcare spending, and supply chain stabilization programs expanded public budgets at wartime scale, without war. In the United States, deficits reached levels unseen since World War II. Similar expansions occurred across Europe, Asia, and parts of the developing world. At first, the results appeared to validate years of deficit tolerance. Economies rebounded faster than expected. Household balance sheets improved. Poverty rates fell in some countries despite economic contraction. Markets absorbed record levels of government borrowing with little immediate stress. But this time, something was different. Unlike earlier crises, the pandemic disrupted supply, not just demand. Factories shut down, logistics networks fractured, and labor participation dropped. When governments injected massive fiscal stimulus into constrained economies, spending collided with physical limits. Prices began to rise. By 2021 and 2022, inflation returned at a scale not seen in decades. While deficits were not the sole cause, energy shocks, supply bottlenecks, and geopolitical tensions all played major roles. They became part of the inflation narrative. The long-standing assumption that deficits could expand without price consequences collapsed. Central banks reversed course rapidly. Interest rates rose. Bond markets repriced risk. Suddenly, the cost of servicing accumulated debt mattered again. This shift revealed a fundamental truth that had been obscured by years of low inflation. Deficits are conditionally safe, not universally safe. They work best when economies have slack capacity, stable supply chains, and credible institutions. When those conditions erode, deficits amplify strain. The divergence between countries widened. Advanced economies with monetary sovereignty adjusted through higher inflation and rate hikes. Their currencies absorbed stress, and central banks acted decisively. But for countries with weaker institutions, limited fiscal space, or foreign-denominated debt, the consequences were harsher. Inflation surged, currencies depreciated, and borrowing costs spiked. In parts of the Global South, pandemic-era deficits triggered renewed debt distress. Governments faced impossible trade-offs: cut social spending during recovery or risk fiscal collapse. The pandemic revealed that while deficits can stabilize rich economies, they can destabilize fragile ones. Public debate shifted sharply. Deficits were no longer framed solely as tools of compassion or stimulus, but as contributors to cost-of-living crises. Political tolerance narrowed. Fiscal restraint re-entered mainstream discourse, not as ideology, but as inflation control. Yet the deeper challenge remained unresolved. Structural pressures, aging populations, climate transition costs, geopolitical fragmentation, and slower productivity growth continued to push governments toward spending. Deficits were rising not because of excess, but because the cost of maintaining social and economic stability had increased. The pandemic did not end deficit politics. It reintroduced limits, uncertain, context-dependent, and politically volatile. Governments learned that they could mobilize vast fiscal resources quickly, but not without consequence. In Segment 8, we'll examine how deficits interact with structural forces going forward, demographics, climate investment, defense, and productivity, and why future deficits may be driven less by crisis and more by slow, unavoidable pressures. As emergency crises fade, deficits do not. Instead, they settle into something quieter and more persistent: structural pressure. Unlike cyclical deficits driven by recessions or shocks, structural deficits arise from long-term forces that steadily push spending upward while constraining growth. These pressures are not temporary, and they define the fiscal future more than any single crisis. The most powerful of these forces is demographics. Across much of the developed world, populations are aging. Birth rates have fallen below replacement levels, while life expectancy has increased. This creates a fiscal imbalance that compounds over time. Fewer workers support more retirees, while healthcare and pension costs rise faster than tax revenues. In countries like Japan, this dynamic has already reshaped public finance, locking in persistent deficits even during periods of economic stability. Europe faces similar pressures. In European Union, many member states confront shrinking labor forces and expanding entitlement obligations simultaneously. Attempts to cut benefits provoke political resistance, while raising taxes risks slowing growth. Deficits become the residual outcome, the space where unresolved trade-offs accumulate. The United States faces a different version of the same challenge. While demographics are somewhat more favorable, healthcare costs grow far faster than GDP. Programs tied to medical spending expand automatically, embedding long-term deficits into the fiscal baseline. Unlike infrastructure spending, these outlays do not raise future productive capacity. They preserve current living standards. Climate transition introduces a second structural driver. Decarbonizing energy systems, reinforcing infrastructure against extreme weather, and adapting agriculture and water systems require sustained public investment over decades. These costs are front-loaded, while benefits accrue slowly and unevenly. Governments face pressure to act, even when revenues lag. Climate-related deficits differ from crisis deficits. They are not reactive, they are anticipatory. They fund risk reduction rather than immediate growth. Politically, this makes them difficult to justify. Economically, it makes them unavoidable. Defense and geopolitical realignment add another layer. Fragmenting trade systems, reshoring production, and rising military expenditures increase public spending while reducing efficiency gains once provided by globalization. Security, like climate resilience, is expensive and produces no short-term economic return. Meanwhile, productivity growth, the traditional escape valve for deficits, has slowed. When economies grow rapidly, deficits shrink relative to output even if nominal borrowing continues. When growth stagnates, deficits become heavier burdens. This is the central dilemma facing advanced economies. The drivers of spending are accelerating while the drivers of growth are not. These structural deficits are harder to reverse than crisis-driven ones. Cutting them requires confronting entrenched political commitments and societal expectations. Financing them through taxation tests economic tolerance. Borrowing fills the gap but accumulates risk. Yet abandoning deficit financing is not realistic. Aging societies cannot simply withdraw healthcare. Climate risks cannot be ignored. Security costs cannot be deferred indefinitely. The question is not whether deficits will persist, but how they will be managed. This brings us to a critical fork in fiscal futures. Some countries will attempt to grow out of deficits through productivity-enhancing investment, education, technology, energy transformation. Others will manage deficits through inflation, allowing real debt burdens to erode gradually. Some will impose fiscal restraint, accepting slower growth and reduced public services. Fragile states may face recurring crises as structural deficits collide with weak institutions. What emerges is a world where deficits are no longer exceptional events, but permanent features of governance. The risk is not insolvency in the classic sense, but stagnation, economies trapped in low growth, high debt, and limited policy flexibility. In Segment 9, we'll examine how different countries are likely to experience this future differently, who can sustain deficits, who cannot, and why fiscal outcomes will diverge sharply across the globe in the decades ahead. As structural deficits become the norm rather than the exception, the global economy is entering an era of divergence. The central question is no longer whether deficits are rising. They are, but which countries can sustain them without crisis, and which cannot. The answer lies less in ideology and more in institutional, monetary, and geopolitical realities. At the top of the hierarchy are countries with monetary sovereignty, deep capital markets, and global currency influence. The United States sits at the center of this group. Its ability to issue debt in its own currency, combined with the dollar's role in global trade and reserves, allows it to run persistent deficits with lower immediate risk. Even when debt levels rise, demand for U.S. government bonds remains strong during global stress. But this privilege is not limitless. Sustained deficits in the U.S. increasingly compete with private investment, and rising interest costs consume larger portions of the federal budget. The risk is not sudden default, but fiscal crowding, a future where more public resources go to servicing past borrowing rather than shaping future growth. Countries like Japan represent a second category: extreme debt sustainability under specific conditions. Japan's deficits persist because its debt is largely domestically held, its central bank absorbs government bonds, and inflation expectations remain anchored. But this stability comes with trade-offs: weak growth, constrained policy options, and heavy dependence on monetary intervention. Europe illustrates a more fragmented future. Within the European Union, fiscal outcomes diverge sharply. Countries with strong export bases and political cohesion manage deficits relatively smoothly. Others face chronic pressure as borrowing costs rise faster than growth. Without unified fiscal authority, deficits become stress multipliers rather than stabilizers. Emerging economies face the narrowest path. Countries with strong institutions, credible central banks, and diversified economies can sustain moderate deficits, particularly when borrowing domestically. Others, especially those reliant on foreign currency debt, remain vulnerable to capital flow reversals, currency depreciation, and inflation spikes. For them, deficits are not policy tools, they are constraints. This divergence creates a feedback loop. Countries able to borrow cheaply invest more in stability and adaptation, reinforcing their resilience. Those that cannot are forced into austerity during downturns, deepening inequality and slowing development. Fiscal capacity becomes a determinant of long-term national trajectory. Geopolitics intensifies this divide. Access to financing increasingly reflects political alignment, not just creditworthiness. Sanctions, trade blocs, and strategic partnerships shape who can borrow, from whom, and at what cost. Deficits become entangled with sovereignty in new ways. At the same time, public tolerance for deficits varies. In aging democracies, voters resist cuts to entitlements but also resist higher taxes. This pushes governments toward borrowing as the path of least resistance. Over time, this erodes fiscal flexibility, leaving fewer options when genuine crises emerge. The future, then, is not one of uniform debt collapse or universal stability. It is a layered fiscal landscape where deficits amplify existing strengths and weaknesses rather than creating new ones. In Segment 10, we'll close by examining the core trade-offs deficits impose: growth versus stability, equity versus efficiency, present security versus future flexibility, and what governments must balance as deficits shift from temporary measures to permanent features of economic life. By the time deficits become permanent, the debate surrounding them changes. They are no longer emergency tools or temporary bridges between crises. They become structural choices, shaping how societies distribute resources across time, risk, and generations. The final question is not whether deficits are acceptable, but what they cost and what they enable. At their core, deficits represent a trade-off between present stability and future flexibility. Borrowing allows governments to act when needs exceed current revenues, cushioning downturns, maintaining social cohesion, investing in long-term transitions. Without deficits, modern states would be brittle, forced to cut spending precisely when demand for public support is highest. But deficits also narrow future options. Interest payments claim a growing share of public budgets, leaving less room for new priorities. As debt accumulates, governments become more sensitive to changes in interest rates, inflation, and market confidence. Policy space shrinks quietly, not through crisis, but through constraint. One of the most persistent trade-offs is growth versus consumption. Deficits that finance productive investment, education, infrastructure, energy systems, research, can raise future output and make debt easier to carry. Deficits that finance ongoing consumption preserve living standards but do not expand capacity. Over time, this distinction determines whether borrowing strengthens or weakens an economy. Another trade-off lies in equity versus efficiency. Deficit spending can reduce inequality, stabilize incomes, and prevent social fragmentation. But financing these outcomes through borrowing shifts costs forward, often onto younger generations with less political voice. Intergenerational tension becomes a fiscal issue, not just a demographic one. Inflation introduces a subtler trade-off. Allowing higher inflation can reduce the real burden of debt, easing fiscal pressure. But inflation erodes purchasing power unevenly, hitting lower-income households hardest and destabilizing expectations. Choosing inflation as a debt management tool is economically effective, but socially contentious. Deficits also interact with sovereignty. Countries that control their currency and maintain institutional credibility can use deficits flexibly. Others must prioritize stability over ambition, accepting slower growth to avoid crisis. This asymmetry shapes global inequality and limits policy convergence. Looking forward, deficits will be driven less by political ideology and more by structural necessity. Aging populations, climate adaptation, healthcare costs, and security demands will continue to expand public spending. At the same time, slower productivity growth will constrain revenue expansion. Borrowing will fill the gap, not because governments prefer it, but because alternatives are politically and economically constrained. The risk is not immediate collapse. It is long-term drift, economies sustaining themselves through borrowing while failing to invest enough to change their trajectory. In this future, deficits stabilize the present while quietly hollowing out the future. The opportunity, however, still exists. Deficits can be redirected toward transformation rather than preservation. Productivity-enhancing investment, institutional reform, and strategic prioritization can restore the balance between borrowing and growth. The question is whether political systems designed for short time horizons can sustain such discipline. In the end, deficits are neither villains nor saviors. They are reflections of collective choices made under constraint. How societies use them will determine not only fiscal outcomes, but the shape of economic life in the decades ahead.